Welcome all to this panel on climate risk organized by The Economist. I'm Fernando Restoy, chairman of the Financial Stability Institute of the Bank for International Settlements, and I am delighted to chair this conversation among highly distinguished experts on this topic. So let me introduce them very briefly. We have Michelle Scales. She's a worldwide risk executive for climate risk at JP Morgan Chase. Rich Sorkin, co-founder, chair, and CEO of Jupiter, provider of climate-related data and analytics. And last but not least, Darren Beckhart. He's a climate change risk officer at the Office of the Controller of the Council. Let me begin with very brief introductory remarks to frame our discussion. So first, the extreme importance of climate-related risk is now undeniable to everyone. One of the few certainties that we have is that physical risks are growing markedly, are actually accelerating over time, and they will continue increasing if we do not only moderate, but even bring to zero the net carbon emissions. And this is, of course, the rationale for transition policies, which are mainly about reducing the amount of carbon that our economies emit. But the financial sector has a major role to play on this. It can and should certainly facilitate this huge reallocation of resources that is needed for a smooth and orderly transition towards a more sustainable economy. There is therefore a need for banks and the regulators to understand the implications of climate change for banks' business models and their risk management practices. In particular, banks need to identify and manage their physical and transition risk and adjust, obviously, their exposures accordingly. But note that managing these climate-related risks implies not only trying to address the direct impact of climate developments on banks' balance sheets, but also they have to address reputational risks, perceptions about the bank's social responsibilities, customers' expectations, etc. On the other side, regulators need to ensure that banks manage their climate-related risk in a sufficiently rigorous manner, but also avoiding a possible overreaction that could actually disrupt an orderly transitions. Ultimately, we will see that climate-related risk will be part of the so-called Basel framework, Pillar 1, Pillar 2, Pillar 3. This may still take some time because there are important technical difficulties as well as data and analytical gaps. We will probably discuss that later. But there is already some relevant work going on at the level of the Basel Committee, and you may have seen some publications on this topic by the committee itself. So this panel discussion, which the Economist has put together, constitutes, I think, is a great opportunity to cover all those and related matters from both the firms and the regulators' perspectives. So I plan to structure the session around 3 blocks, pretty much hope that we are going to be able to cover those three blocks because the 3 of them are quite important. So we'll first discuss about the overall strategy followed by firms in order to address climate-related risks. The second block will be more technical about data, about tools, actually, for risk identification, risk measurement, and risk management as well. And then the third block will be about policy, about regulation, how regulation and public policy should actually sort of address all the implications for society of the climate-related risk. We only have 40 minutes or so now. Slightly less than that. So I have asked the speakers to be brief in each of their interventions. I'm sure they're going to comply with this kind recommendation. So let me start by giving the floor to Michelle on the first block on what is basically your strategy that you are following, your firm in relation to climate-related risk. Of course, you may want to take the opportunity of this first intervention to comment about some general issues that you may want to convey to the audience, but please stick to a few minutes, 3 or 4 minutes maximum, please, because we have to cover a number of issues, as I said before. So, Michelle, you have the floor now.
Thank you. We all know that climate change is one of the most critical challenges of our time. And we want to do our part to facilitate the transition to a low carbon, more sustainable, and inclusive economy. Towards this, we're focused on three key strategic areas. One is helping our clients transition and reach their sustainability goals. We were the first major US bank to set 2030 targets for key carbon intensive sectors in our financing portfolio. Our carbon emissions targets are aligned to Paris, and it's an important step towards accelerating transition and encouraging near-term action that will set a path to limiting global warming. We're continuously expanding our capabilities to help our clients, and over the years, we've launched a Center for Carbon Transition, a commercial banking green team, and a global market sustainability center. Second, we're helping green go big by targeting $1 trillion over the next 10 years to support climate action and financing of green initiatives, such as renewable energy and clean technologies. Last year, the firm was the top underwriter for green and ESG-labeled bonds by volume. Three, we're walking the walk by minimizing the environmental impacts of our operations, including achieving carbon neutrality in every year beginning in 2020. As the firm-wide risk executive for climate risk, I am responsible for integrating the impacts of climate change into our firm's risk management processes to identify, assess, and manage climate-related risks. Climate change presents both physical and transition risks, and I lead a team of climate science and risk specialists who are helping to translate how climate-related drivers will manifest itself as risks with our clients, our customers, and the firm. Thank you.
Many thanks, Michelle. Very clear and right to the point in just a few minutes. Thank you very much. So, Rich, you are next. The same question to you, general strategic issues.
Thank you. We appreciate the opportunity to join you today and echo all of Michelle's comments and applaud their leadership on many of these issues. I think it's worth noting that this is a new class of risk that banks are not set up to address today. In some respects, you can think of it as a new variable to integrate into existing risk management practices that I think Michelle will talk about a little later as well. In the same sense, the rest of the economy is also adjusting to this new class of risk. In physical risk, the key issue is essentially duration mismatch. Risk management today largely uses backward-looking approaches to assess the current year risk for risks that are actually worsening over time. Most banks and lenders are in the early stages of learning how to manage climate-related financial risks at scale. At Jupiter, we have a broad perspective on this because we have worked across the US with both some of the world's largest banks and GSEs and across the world. Some early adopters began working with us 3 years ago and are deploying the third generation of Jupiter services across their entire loan portfolio. Similarly, our services have matured during this time with continued R&D and ongoing input from our customers. Most advanced banks and lenders began with pilots to address physical risks in highly exposed places like Florida, Houston, and California, and expanded their use of analytics to ever larger portions of their portfolios. Others are still assessing how to get started. The vast majority of banks are still in the process of determining what's material and what to do about it. The balance of their emphasis on transition risk and physical risk, and by physical risk, I mean things like, for example, if a fire in California wipes out an entire town and causes unexpected increases to default or repayment risk, how does that get treated, especially if insurance markets retreat from covering the risks at unprofitable rates? And how can banks best serve their own customers along the lines of what Michelle was talking about earlier? For example, in Japan and parts of Europe, the government is pushing the financial services sector to provide services to their customers to better understand and manage these risks. Lastly, capacity and governance building is also essential. Almost all of the very largest banks have been building internal groups for the last year. In some cases, they began with very little, and in others, they're building on a few years of preliminary work. These groups are defining corporate priorities, writing RFPs, building relationships externally, and driving sourcing strategies. Thank you.
Very good. Thank you. Thank you very much, Rich. So we have heard a good example of an important bank actually modifying its strategy in order to address these new risks. Examples intervention by Rich shows how some companies are providing services to firms in general to be able actually to implement and develop those strategies. So, Darren, now from your regulatory viewpoint, I mean, how do you see actually the the developments in the private sector, how firms are actually adjusting their strategies to cope with this important new source of risk? What is your view from your OCC job?
Thank you, Fernando. Appreciate the opportunity to be here today. I would probably echo what Rich said already. I think what we've seen is that banks are really in the early stages yet. Obviously, we've seen most banks have focused on a lot of external engagement on this topic and have a lot of voluntary disclosures on the topic, but there probably hasn't been as much emphasis on kind of the internal risk and really quantification of the physical and transition risk. And I think that's where, as we go through the rest of this panel, you'll hear a lot of discussion around the challenges that banks face in that area. And I think one of the themes that you'll hear me talk about, which is one of our key areas of emphasis, is the establishment of a risk management framework and the importance of integrating that into how a bank thinks about the risk and measures and monitors and then ultimately controls that risk. So with that, Fernando, I'll turn it back over to you, and I'm sure we'll have a lot more things to talk about as we get to the next topics.
We will for sure. Of course, I'm looking forward to our last round, in which we could be more specific about policy and supervisory actions in particular. Great. So let's now move to the second round. This is about techniques and data. It's about actually sort of the type of approaches currently used to identify or to measure relevant climate-related risk in different firms. So, Michelle, could you please take the floor on this? I mean, how do you see the situation in terms of data availability, in terms of availability of also analytical tools that could be helpful for this undertaking? So what is your firm doing in relation to all this? Michelle, please.
Thank you. I think the first thing I would say is it's important to understand how climate risk can impact the spectrum of existing risk types such as credit, market liquidity, and operational risk. And we are treating climate as a risk driver that is being integrated into existing risk types, as opposed to introducing a new standalone risk type for climate. So as it's been mentioned, climate data, risk measurement, and modeling methodologies continue to evolve at a rapid pace. And we are operating in a hyper-analytical discovery mode to understand how these climate risks may impact our client and customer creditworthiness across a range of potential climate scenarios. And so I think the first important step here is to identify pockets of risk and assess materiality before we start incorporating climate risks into existing risk management frameworks and policies. So a lot of the heavy lifting has to be done. And we are on a journey in understanding and expertise in climate risk identification, assessments, and quantification capabilities. We're recognizing that the heavy lift ahead of us is how to translate these climate-related impacts into our existing probability of default and loss given default risk models across our lending portfolios that are sensitive to climate change. So there's a lot of work and investment being done around that. The second is we've already completed a complementary or preliminary work to incorporate climate-related risks into our risk identification frameworks. And we need to continue to enhance this framework, the identification process, for our climate risk taxonomies as our understanding of climate-related risks and their transmission mechanisms evolve. We're expanding our existing risk appetite, or looking at ways to expand it, so that we can more broadly incorporate the quantitative and qualitative impacts of climate risk into our business strategy and risk taking. So I think that's another important area that we're highly focused on. So I will stop there just to open up the floor.
Great, many thanks. I think you summarized very well, actually, the most relevant technical challenges, actually, for you to measure climate-related risk. Rich, what is your perspective about this?
Well, first of all, I'd like to emphatically agree with Michelle's comment that while climate risk is a new form of risk, integrating it into existing frameworks that are material to the economics of the banking sector is kind of a crucial perspective. Within that context, again, nearly all banks are in the early days of developing credit policies incorporating climate-related risks. To some extent, we're seeing banks don't want to get too far ahead of the evolving regulatory landscape, and also these types of changes do take time. Also, generally speaking, banks are still learning about the risks as a building block to developing and implementing credit policy. For most advanced customers, see this as an inevitable requirement and are positioned to be leaders when that evolution occurs. Jupiter's customers are evaluating their loan portfolios, determining the best action to take based on what they're learning. Again, the most sophisticated ones are at the disclosure stage. They can say what their current risk is, including default risk at the portfolio level, where concentrated risk exists, and how that's changing. But few have yet to meaningfully change their underwriting or pricing practices. To put this in perspective, our largest banking customers have now assessed nearly 100 million loans. Another observation is that the execution of credit policies tends to be a function of the sophistication of risk management and internal analytics groups. Banks with a history of strong risk management practices tend to be further along on these issues than ones with weaker risk management. Generally speaking, where banks fall in this spectrum of risk management discipline is fairly well known among regulators and within the industry. And a track record of fines is a strong indication of where problems may exist. The strength of internal analytics also tends to determine whether banks are doing much of this work internally or outsourcing to firms like Oliver Wyman or BlackRock, or even in some cases, Jupiter for work beyond physical risk data we provide. Hemingway talked about how change happens, slowly and suddenly. We're still largely in the slowly stage, with the suddenly inflection point arguably in sight. It's worth carefully reading Fannie Mae's comments on this topic in the recent public statements. And we believe it's a positive sign that these institutions are taking these early steps. Jupiter is working with a number of companies to help them drive action from the data.
Great, many thanks. Many thanks, Rich, for your optimistic view about this issue. So what is your view, Darren, on this? How is the situation? Is that bad in terms of data gaps, lack of, valid taxonomies, about actually methods that could actually be employed, for instance, to calculate PDs, LEDs, and so on? What is your perspective in relation to this?
So again, as we've already said, I think banks are in the early phases, and I think from a regulatory standpoint, I think we're also in the early phases in that we don't want to create a regulatory regime that too narrowly suddenly defines something when there is still a lot of iteration and innovation going on in actually determining what the best ways are to measure and monitor the risk in this space. And so we're trying to be a little cautious. That's why you're seeing us stick with principles, high-level principle-based guidance or draft guidance out there right now as we go through the learning process. I would definitely echo the fact that data is going to be one of the biggest challenges out there. I think banks are every day discovering new information as they get more in tune with the science side of this, and try to build that bridge to the financial side. There is, clearly information that they realize they don't have today. Examples of that could be topographical information that ties directly with the assets, actually understanding where some of the assets are at. They know where their borrowers are at, but that isn't necessarily where the collateral or the assets are at. I think another good example is, potentially having to rely on industry codes, which can be very basic in some ways and may not, fully reflect the business that the industry or a business that a company does. And without disclosures to kind of better understand that, it leaves them challenged, and that can especially be the case with private companies who may not have public disclosures out there. And so I think that's going to be a real area that banks are going to have to tackle and think about. I think, banks are definitely still in the early days of scenario analysis and figuring out how they adapt their models. Banks have all kinds of models out there that they are used to using every day, but not necessarily for the time horizons that scenario analysis contemplates in the climate risk space. So they're having to think definitely about scenario analysis. And then lastly, I think one of the challenges that we hear a lot about is the expertise and building out that expertise. It's difficult to do good, solid risk identification if you don't have a good foundational understanding of how this risk may apply to your area. So I think those are definitely things that we're seeing out there. And I think, that's just the first level of challenges. Clearly, as we've done some range of practice work, we've had, banks ask us questions about, well, how do we do climate model validation and how is that different? What is the data standardization or taxonomies that we should use? There's no consistency. What granularity of data do we need to have? Or how do you deal with nonlinearity of risk out there? So again, there's a whole nother level of detail that I think, we'll have to get to at some point in this area.
Yeah, thank you, Darren. Of course, you're absolutely right that we are still in the short end of the learning curve. Much have to be done, but it's also true that we should start sort of establishing the basis for a good climate-related risk assessment on the course, right? So that's why this discussion about data, about methods and models and tools is particularly relevant, because now, of course, it's time to try to figure out what type of enhancement we need in the current methodology and data infrastructure in order to make those assessments actually possible, right? So, for instance, if I can ask a follow-up question here. Two debates. One is about disclosures. Of course, we need actually to know more about the climate exposure of basically of firms borrowing funds from banks. There is some initiatives now by accounting standard setting bodies in trying actually to establish new standards for the disclosure of climate exposure by firms. Darren, you are right that you have a number of companies all around the globe which are not subject to those sort of sophisticated international accounting standards. But do you think that this actually this initiative is actually worth the effort? It's going to be a huge effort. Do you think it's going to help actually completing the information set that could be helpful in order to properly address, in particular, banks' exposures? That would be one possible question that you may want to address. A second question is about taxonomies. Of course, much discussion about taxonomies. And there is also a non-conclusive debate on whether we need sort of universal common taxonomies, or we should rather actually develop more specific taxonomies that may be helpful for different types of institutions. So not one size fits all. Yes, we would like to ask you, well, you have a view to express in one or the other question, so we can now move to the policy chapter in our session. Any views about that? Accounting standards on disclosures, first, second, about taxonomies?
Well, I can just start. I think, again, back to my comment earlier, I think we're trying to be a little cautious in, setting up too much specificity, at least in the U.S. I know other regulators around the world this has clearly been a topic. They've set out some taxonomies and tried to address that. I think in the U.S., we're probably still a little bit in the early phases of understanding that. And of course, at the OCC, we are going to defer to the SEC domestically around, kind of what they're doing in the disclosure space. But I think that is a key piece of information. Interestingly enough, as we look at some of our banks, most of our banks, subscribe to one of, there 6 or 7 different climate-related disclosure groups out there that you could use. And again, as I said earlier, I think to a certain extent, these early disclosures really focus on kind of what the bank is doing themselves to be, I'll say, a good corporate citizen in this space, but doesn't focus a lot really on what risk may be facing the banks at this point. And so I think we're looking forward to that kind of next iteration that starts to discuss some of the risk out there.
Thank you. Any other remark on this, or yes, Rich, and then we move to policy. Rich, please go ahead.
4 quick points. The first is I think there needs to be better and more common approaches to the definition of materiality. That's not necessarily a regulatory question, but certainly something that would be very helpful. The second is there's a bit of a Tower of Babel in the way that companies talk about these risks. So some standardization on which climate scenarios, what time horizons, what risk thresholds they're using would certainly be helpful in comparing the approaches. Thirdly, from a global perspective, we are moving towards, but are not quite at, harmonization of regulatory approaches, which makes it more expensive for various different financial institutions to comply and also slows them down. And then lastly, for most of the most sophisticated banks, they have established model risk management processes that are scrutinized by regulators for both safety and soundness, as well as for consumer loans, fairness, and integrating these risk discipline related to climate risk into that broader framework is clearly a very important part of the overall process.
Okay, many thanks. I think it's a good introduction actually for the policy round. So let's move now to policy actions. Now we are seeing that a number of regulators are moving. They are organizing climate stress test exercises. The Basel Committee now actually have recently issued for consultation a document on principle for climate risk management. The OCC, as we are here for sure, is also active in this domain. So what else should be done by the regulatory community? Or if you want actually just to comment on general policy issues, of course, you're absolutely welcome to do so. Let's start with regulation. Let's start with Darren. What can you offer and to introduce this debate about policy actions and in particular regulation?
Thanks, Fernando. I think as you started out, climate is clearly one of my acting controller, Sue, for the OCC's priorities. And so we've tried to take a leadership role in that space from a U.S. Standpoint. I think the Financial Stability Oversight Council report on climate risk was a great foundational document that laid out some of the potential risks that climate could pose across the financial system. And so we've used that as kind of a springboard to really begin our work in this area more in earnest. And so we here in December 17th issued the draft principles that we put out for comment for a 60-day period. Of course, those are very much aligned to the consultative document that the Task Force on Climate Risk from the Basel Committee also put out. Interestingly enough, they both have similar end dates in February for their comments. So again, I think we're looking forward to hearing from the industry and a number of interested constituents on what their thoughts are on those. Again, at a high level, it really is about establishing a sound risk management framework. The guidance deals with governance processes and the expectation that banks would lay out responsibility and accountability. Obviously, policies, procedures, and limits, strategies, and risk appetites would be aspects of those that we would be looking for banks to be making progress on. Of course, we would expect that they would also integrate this into their strategic planning processes. As we've already talked about, data and risk identification, how are they going to begin to measure this is going to be a critical part. Scenario analysis. And then finally, I would just say, as has been talked about here also, how does this integrate into the traditional risk areas? I think in the climate space, the number one emphasis tends to be the credit space, and that's the first place that folks tend to go to, which is very relevant. I won't disagree with that, but there's clearly a growing amount of activity in the market space in this area, and that's going to be an area that banks are going to definitely need to think about. Operational risk. We don't want banks to forget about climate implications in that area. And some of the other ones, legal compliance, strategic and reputation risk also play a part in this, especially as banks are making their own commitments and making their own decisions around how they want to progress with that. That definitely lends itself to strategic and reputation risks. So those are also areas that I think I would just kind of throw out there and remind banks about. I think you're going to obviously continue to see a lot of regulatory activity in their space. There's already been a lot. I think just as an example, obviously this summer or in 2021, the OCC joined the Network for Greening the Financial System. And as of last count, I believe there were over 100 now regulatory bodies and central banks who are part of that group. So clearly, this is a growing initiative around the world. You're going to continue to see, as you mentioned, Fernando, the Basel Committee is going to remain very active on that. And of course, some regulators would call out the EBA as well as the PRA in the UK are very active, putting out recently expectations on reporting in the climate space. So we're going to, from a U.S. perspective, we're going to continue to monitor and see what we can learn from what some of the other regulators are doing on the international space.
Okay, thank you very much. I think it's a very good heads up that the action, supervisory regulatory action, is actually going to come in a more intensive way in the forthcoming future. Michelle, I'm very interested in your perspective from the private sector. So what do you expect from regulators, in particular prudential regulators? How do you expect regulation to evolve to fully embed actually implications of climate-related risks?
So we are, actively participating with regulatory surveys, exploratory meetings, and deep dives across the globe with supervisory approaches as these approaches are being developed for managing climate-related risks. And we're also involved in actually satisfying and regulatory requirements and expectations. Darren mentioned the EBA, which is going on right now. And, what we support, and we're actively involved, as Darren said, through the industry in responding to all the regulatory guidance, including the recent guidance from the OCC. And we support a principle-based supervisory approach that allows for flexibility as our climate management approaches and tools continue to evolve. I think that's critical, given the discussion here around us as banks of our size and complexity, trying to understand how to embed climate risk as a driver, which is a fairly new space for us, into existing practices. And I think I agree with Darren beyond. We're definitely all approaching the credit world and our credit exposures, but also market risk, assessing our business resilience to future, weather events, which are going to, obviously, not only the frequency, but the severity is going to increase. And so what we've done in the past is no indication of what we're going to see in the future. So I think having that flexibility in terms of how we embed climate into our risk management approaches is going to be critical. And then as an international bank and a global bank operating in over 70 countries, I want to just encourage domestic and international coordination among regulators as supervisory approaches are developed and finalized, only because of the complexity. And we are doing that, but it does, I think, slow us down in terms of how many different approaches we have to undertake and try. And there's a lot of effort internally, as it is, in understanding how we're going to land, which scenarios we're going to use, how do we address the timeframes, and how do we appropriately incorporate model governance in terms of climate scenarios that are really forward-looking, and there's no backtesting or data. There's no indication of the past that's going to help us with these future predictions on things like carbon price, technologies that are evolving, all of which is going to have an impact on how successfully either clients are transitioning or how climate change is going to be impacted to think about physical risk. So, we welcome the discussions, and we're very much looking forward to partnering with the regulators around the world in strengthening our risk management practices.
Great, many thanks. This is very important, this interaction between the official sector and the public sector here. Rich, last word. I can give you slightly less than 2 minutes.
So very briefly, in the time remaining, first, I definitely agree with what Michelle and Darren just said, both on the importance of global harmonization as well as a careful approach that's timed to the availability of fit-for-purpose data. And in some regions of the world, the regulators, in some respects, have maybe steered some of the businesses to data that may not be quite fit for purpose. So same kind of capacity building that I talked about inside the banks is also occurring inside some of the regulatory bodies globally, which is something to be careful about. The last point that I would make is, and it's a little bit more general, is that most of the regulated domiciles are democracies, and the overall approach to this is going to be somewhat metered by the will of the people beyond just the views of regulators. And the best we can hope for is a consistent approach over time that doesn't oscillate with political currents, because that's difficult and kind of backward for everybody. So hopefully we'll see that within governments through time. And again, it was really a privilege to join you all today. Thank you.
Great. Many thanks to all of you. We could have been here for hours actually discussing these very important issues. But I'm sure, this is a topic that is going to remain with us for the years to come. I'm sure that the economists and others are going to organize many more actualizations on climate-related issues. I'm sure that there is a very good chance that we'll meet again, actually probably to discuss this topic sometime in the near future. So thank you very much. Thank you, the economists, for putting this very interesting panel together. So long. See you soon.